Hello everyone and welcome to the Quantpedia Explains Trading Strategies video series. Today we will discuss refining ETF asset momentum strategy.
Hello everyone, my name is Radovan Vojtko, I'm CEO and Head of Research at Quantpedia. Today we will discuss ETF asset momentum strategy. Especially we will try to improve or refine this basic strategy that I believe a lot of you know. Very quickly, what is our refinement based on? In the past we had an article called Robustness Testing of Country and Asset ETF Momentum Strategies. In this article we tried some different investment universes and we tried how the basic momentum strategy works like, and we realized that very highly correlated investment universes like country ETFs, they fail to deliver significant alpha. So we tried to look for a way how to improve using the momentum in this kind of the investment universes, and our response was the article called How to Improve the Commodity Momentum Intra-Market Correlation. So we firstly tested the idea to use the correlation, the difference between short-term and long-term correlation in the market that you try to trade as a predictor for momentum in commodities, because the commodities are usually very highly correlated. Then we had another article, How to Improve ETF Sector Momentum. Momentum in the sectors is also very hard to use because the sectors are usually highly correlated. Improved ETF sector momentum strategy. We try to selectively short part of the investment universe as a hedge, and it improved our risk to return ratios. So these are like our ideas. And in this article we will try to use all of these ideas all together, and we will try to improve the ETF asset momentum strategy. So what's the ETF asset momentum strategy? So it's a very highly diversified investment universe. So we use 6 stock ETFs, 3 bond ETFs, 3 commodity ETFs, 1 currency ETF. So we are really diversified among all of the asset classes. So investment universe is not so highly correlated, so not correlated to each other, but we still can improve the momentum strategy in this investment universe. So we have 14 ETFs and our backtest period spans from April 2006 until February 2023. We can divide the analysis into 4 main steps. So firstly, we build a simple momentum strategy using the price data. Then we add the correlation filter. We check how the correlation filter helps to the momentum strategy. Then we check the optimal number of assets, so how many ETFs should we use in the strategy. At the end, we try to find out what is the optimal weighting sum for the short leg. So we try to short some part of the investment universe to improve the risk-return ratios. So the first step in our analysis was the simple test of long-short momentum strategy. So we are going long some number of assets, in our case 4 assets, and we go short assets or 4 ETFs. And we are interested to see what's the performance and how does the performance compares to the benchmark, and the benchmark in our case is equally weighted investment universe or equally weighted universe of all ETFs, because that's your benchmark. So when you are building a strategy, you are trying to build a strategy that's better than the average ETF that you have in your investment universe, and your investment universe can be anything. In our case it's 13 ETFs. So here we have our results. As you can see, the long short momentum strategy doesn't work at all. On average there's like no alpha against the benchmark, no combination of predictors. So we can use 1 month, 2 month, 3 month, 12 month momentum as a predictor improves over the benchmark. We decided to identify what's the problem, so we split this momentum strategy into the long leg and the short leg. So we have the long only momentum strategy. So in this case you go only the long part of the strategy, so you only buy the ETFs that are the best performing, and here we have the short only, so you short the ETFs that are the worst performing. And here we can see where is the problem. The problem is the short side. So the long part of the strategy is still working very well. So when you have investment universe that consists of multi-asset ETFs and you select a subset of them, you go long only of them, you have like very high probability that you will beat the benchmark. The benchmark is equally weighted average of all of those ETFs. So in diversified portfolio, the momentum works very well. We can see it here. The problem is with the short side. So the short side is used for hedging. Short side has a merit in the momentum strategy because you want to use the short side to have a better return to risk ratios. In this case, it doesn't work very well. So the first idea was, let's use the correlation filter. So we try to use the correlation filter. Once again, we are looking for a predictor that compares the short-term 20-day correlation and 250-day correlation between the assets or between the ETFs in the investment universe. And if the correlation is higher, we go long, we use the momentum. So what we can see is that in this case, the correlation filter doesn't help the momentum strategy. Why is it so? Probably Our hypothesis is because the investment universe is really not very correlated. So I mean the correlation filter works well in the investment universe that is, I mean, denser, more correlated, like commodities or I don't know, countries, but not in multi-asset ETFs. And then we try to take a look on the short side, and in the short side we can see that the correlation filter significantly improved the short strategy. So the short leg of the momentum strategy. So what does it mean? Here we have a difference. So I mean, when the short-term correlation is higher than long-term correlation, when we are shorting the worst ETFs, yeah, of course we do not have the positive performance, but the strategy or the short leg hedges very well against the downturns. So here we can see on average the blue line shows what is the average performance of the ETFs, and the green line shows how the short leg is performing, and you can see that the short leg is performing very well. So it works exceedingly, I mean, really well as a hedge, and we do not pay a lot. I mean, we pay, I mean, nearly nothing, or I mean, there are even the cases in which we are shorting or hedging, and we are even receiving some money from the short positions, which is really great. On the other hand, when the short-term correlation is lower than long-term correlation, we can see that the short leg is, I mean, really not performing very well. So it's best to avoid shorting at all or at all costs in this kind of situation. So when the short-term correlation is lower than long-term correlation. So when the short-term correlation is higher than long-term correlation, we have very cheap hedge, very good hedge, that we can use as a hedge for the long only part, the momentum which we have here and which performs really well. Okay, let's move on. Here we have a question: what is the number of the assets we should use? So we tried different periods. Firstly, we decided to use industry standard and use the average of the time frames 3, 6, 9 and 12 months in the next step, because I mean there is like not significant difference between using the 3 month or 12 month or whatever. So we try to be diversified in the time frames that we use in the momentum strategy. So we use the average 6, 9 and 12 months, and this is our setting for the momentum. And here is the question: what is the number of the assets we should use? So firstly, our interest was in the long only leg. So what is the number of the assets we should use in the long only leg? Of course, the best performance is when we select only the one ETF from the investment universe from all of the 14 in the long leg, but the Sharpe ratio and the Kalman ratio is not the best. So the Sharpe ratio and Kalman ratio is better when you are a little diversified. So you can buy 3 or 4 or 5 best performing ETFs into your long leg. I mean, we think that the best plus or minus the best 3 or 4. That's the sweet spot when you select really the best performing ETFs for the long leg. On the other hand, you are diversified enough so that underperformance of the one ETF that you selected will not have a high impact on the performance of your strategy. So it's better to have like 3 or 4 ETFs in the long leg. Okay, and the question is, how many ETFs should I have in the short leg? In the short leg, it seems that it's better to have like less ETFs. It's fine to have 2 or 3 or even the 4 ETFs in the short leg, but the best is to have just one ETF in the short leg. You have even the positive performance when you are shorting just the one worst ETF in the short leg. What is the final version? So the final version is, let's go long on a monthly basis. Let's select the 4 ETFs with the best performance on a 3, 6, 9 and 12 month period. Let's go long these ETFs, and let's short one ETF that has the worst performance on 3, 6, 9 and 12 month period. Now the question is, what should be the weight of that short leg? 100%, 70%, 30%, 20%. Once again, here we have a robustness test. So if we short just like 5 or 10%, yeah, we are improving the performance a little, but it can be significantly better. If we short around 30 or 40 or even 50% of the short leg, then I mean we have the better Sharpe ratio, the better Kalman ratio, lower drawdown, etc., etc. What is the sweet spot? Once again, I mean we think that the sweet spot is around 40%. I mean I would be afraid to short more than 50% on the short side, because I mean in this case you have a very good hedge, but maybe in the future it is possible that in case the hedge will not perform the way you expect, you will lose some, I mean significant part of the long leg performance. I think it's not worth the risk. So it makes sense to have the short leg, but I would say around 30% is like enough. And in this case, you have the better Sharpe ratio, better Kalman ratio, better performance, etc., etc. So what's our conclusion? So we are able to improve or enhance or refine the asset momentum ETF strategy very easily. So we are using the correlation filter, calculated as a ratio of 20-day to 250-day correlations among the ETFs, and we selectively short 40%. We short one ETF with the worst performance, and we go long 4 ETFs with the best performance on the average of the 3, 6, 9 and 12 month period. Now this strategy should be rebalanced on a monthly basis, so every month you should do the recalculation, find the new ETFs for the long leg, find a new ETF for the short leg, and once again after the month do the recalculation, etc., etc. So it's a monthly based strategy. So I hope that you like the short analysis. This is how it usually look like when you are building the trading strategy. So we are looking at how does it look like, how the strategy performs when you change some variables, when you change how many assets you choose into the strategy, when you change the time period over which you do some calculation, when you change the weighting, etc. And you are looking on the whole picture, and you are trying to understand, what is the change in the strategy when you change some variable. You are not picking exactly the one optimal spot, but you are picking, the spot that's, robust. And in our case, the strategy is performing well, but there will be not a big difference if we select not one ETF, but 2 ETFs for the short leg, and not 4 ETFs, but 5 ETFs for the long leg, etc., etc. So, you can change the variables in the strategy, and it will perform plus or minus the same. But it still will perform better than the benchmark or just the long only strategy. Thank you very much for watching this video. If you are interested in what we do, feel free to visit our webpage, Quantpedia, check our investment database or our database of trading strategy ideas. Give us the like on our video, it will help us a lot. Subscribe to our channel, and I hope that you will join me in the next video. Thank you very much.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.